This meeting is being recorded.
Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with his newest expert, someone a little different, somebody who has a decade of experience on Wall Street, runs an ETF or a collection of ETFs, which we will get into in a later interview. We brought back Taylor. How you doing, buddy?
I'm doing great. Thanks so much for having me, Michael.
I read a couple of articles over the weekend, and I'm like, I am glad Taylor's coming back on Monday.
Uh-oh.
Yeah.
Fastball.
Yeah. I don't play around, man. You're an expert for a reason. So, hey, I want to set the stage because BlackRock and Goldman Sachs are at least messaging entirely different things. Now, I believe Wall Street always talks their book. I believe if you gave them both true serum, they might actually say something else. But let me just say BlackRock and Goldman Sachs, in your experience in the Wall Street industry, these are two big names, very well respected. You want to give me a little color about both before I get into what they're saying?
Yeah, no doubt. They both are kind of the top tier asset management firms that are out there. When I say asset management, they do a lot more than that. They are very wide breadth and they're very influential on our overall economy in general. They both have a very, very strong name when it comes to the actual asset management side of things. And I think what you're getting at here is they might have different product sets when it comes to asset management. One of them may have a strong product set that might be less interest rate sensitive, and the other one may be more interest rate sensitive. And to your point, talking your book in the direction of, I think rates are really going to go up quickly because I have a product set that's really going to benefit because of that.
Exactly. So let me lay the stage, because again, it was really I read these articles almost back to back, which was just luck of the draw. BlackRock, I think they're the largest, I don't know what you call them, hedge fund, money management fund on the planet, right?
Asset manager.
Thank you. A couple of $1 trillion, right? The biggest of the big.
With the T.
With the T. Yeah, exactly. Isn't that amazing? Anyways, they have come out and basically said the Fed is talking tough. Yes, they're going to move in June or May and June, a half. I think everybody has come to that realization. But then BlackRock is basically saying the market is overplaying the Fed. The Fed's going to be far weaker after these first two moves. BlackRock basically painting a picture where the Fed gets to about 1.5 and doesn't go much higher, and ultimately could find themselves backing off that. That's BlackRock's thought. Very next article, or maybe the one after that, I read, Goldman comes out and says the market, meaning Wall Street, meaning stock market, is not appreciating that the Fed is going to get uber aggressive. The Fed's going to take us to 2 3/4, 3 this year, and ultimately as high as 4 on the Fed funds rate before all is said and done. So again, two very different opinions, two highly respected firms. I certainly know where I stand, but I give you all that. What are your thoughts?
Yeah, I tend to fall more in the BlackRock camp.
Oh, and I'm on the Goldman side. Yes, I like disagreements.
We're diabolically different on this. And I think that to the point of BlackRock, I think what's going to happen here is you're going to see corporate earnings coming out here in the next week or so. They start from the big banks. Tomorrow. And we're going to start to get an idea. Correct. Yeah, exactly. Tomorrow, we're going to start to get an idea of how the economy has shifted, how inflation has started to play a role in what's going on in the overall economy. Now, banks are generally what leads off the economic calendar. So banks are a little different, where banks actually tend to benefit from higher rates.
Well, let's talk about that, because that has been historically correct. We're going to see tomorrow. Here's an opinion. Again, I always share my opinion, probably too much.
But please do. It makes it fun to listen to.
Yeah. Normally banks benefit from rising rates. Absolutely correct. In fact, I made a bet on Fifth Third and a couple of other banks months ago, thinking that this would happen. Rates have moved so far, so fast. I am waiting for one of the big five, and I don't know who it's going to be. It might be Wells, it might be Citi, but one of them is going to say something like loan growth has deteriorated. Loan activity, or whatever metric du jour vocabulary they're going to say, it's going to shock people, because again, rates went too high too fast. And I believe we have loan destruction. And one of the banks might say the dreaded word layoff.
Yep.
What do you think of that?
Yeah, it could come about. In the short term, I think this is a positive. And the reason I say that is because you look at all the deposits that sit on the books of the banking industry, mostly in the form of savings accounts. Savings accounts haven't moved whatsoever.
Not at
So
all.
they are still at an average of 0.05% interest rate that they pay to you and I.
Yeah.
Pay. We'll call it pay. Yeah, right.
Yeah.
That they carve up a penny and hand it to us each.
Yeah, exactly.
But on the other end, the adjustable rate mortgages, the adjustable rate credit cards, the adjustable rate things
cards.
are all ticking higher meaningfully. So to your point, there is definitely going to be a slowdown in loans. And that's the whole kind of quandary that the Fed sits in. It's, how do you raise rates and yet still have people desire to borrow money on the one side? That's the key, is how quickly do you move rates where people still want that money, because you have to offset inflation on the other side. So I guess going back to your original question of like, hey, what happens with this rate hike cycle that we're in, is I tend to think that the economy is not quite as strong as what, maybe you or Goldman thinks, or I'm not putting words in your mouth, but
No.
To think that we could raise to 4% from a Fed funds rate perspective, that would take a really strong economy and a really aggressive Fed to allow us to get there. I tend to think you're going to see some softening of earnings right now in this cycle that we're coming through right here at the end of Q1.
So the next 10 days, you're going to see softer.
Yeah. And what does that do? That causes the Fed to open their eyes and go, if earnings are slowing and projections from companies are saying that earnings are slowing further, we cannot raise rates as aggressively as we're dictating to the market at this point. Because the market essentially thinks on a whole, on average right now, you're going to see 7-ish rate hikes through the end of the year. And now that's at 25 basis point clip. So mind you that. But nonetheless, that is breakneck speed that we have not seen in decades.
Yeah. So 7 more rate quarter points. Again, it could be half, which would be 4.
Yeah. Right. Yep.
So 7 more, that takes us to 1.5. Is that right? No, it takes us to 2.
2. Yep.
Right. So I'm calling for 2 3/4. So that's essentially where we break, right? The top is 2. So here's what I see. And I think we talked a little bit about this last week. I actually believe there's so much forward momentum right now, and it's really the jobs market, right? Whatever, we have 1.8 job openings for every unemployed. We just had 156,000 lowest new unemployment claims since 1958 or some freaking number. Wage growth at 5.2% and likely going higher. We have we have deglobalization, which is going to be inflationary. We have this $1.9 trillion Build Back Better or what infrastructure thing coming. I think there's so much forward momentum that I see the economy growing just by inertia into the end of the year. The Fed not seeing it. I think inflation rolls over because of the base effect here very soon. In fact, I think tomorrow's CPI might be the high, knock on wood. But I don't think it goes down below 6%, which is still a crazy inflation. So I think they've got to get it up. I think they're going to have to break something, and I think they break it next year.
Yeah, well, you look at the market right now, and you can look at 5-year forward inflation expectations. I looked at them just prior to this call, and it shows 5 years out, the market anticipates inflation being about 2.6, 2.7%. So
5
that
years
shows
from now.
5 years from now. So granted, that's a long period of time, but nonetheless, that shows back towards, almost long-term historic norms, which is a little lower than that. But nonetheless, I mean, that's showing a meaningful breakdown in inflation. And that's a breakdown we are welcoming with open arms by all means. I mean, there is a couple things going on. One of the things that's really, really, really spooked the market is this war that's playing out in the Eastern Bloc. And one of the things that's doing is it's causing a ripple effect. No one is necessarily all that scared of the Russian economy starting to falter and that spilling over into this global kind of quandary. It's more of, hey, are we too interconnected? Germany right now is realizing they are much too interconnected with Russia because they are completely dependent upon Russian oil. 90%. So what they're saying now is we need to start to break some of these economic ties. And with that is certainly an inflationary pressure.
Agreed.
You listen to Kathy Wood and kind of her perspective is we're in a deflationary world because of all the technology that's played out and all the improvements we've seen in manufacturing and robotics and all of these things that have caused things to be so much more productive. So you can see both sides of the coin there. In the short term, the inflationary scare that's going on from the war in the Eastern Bloc is really, really causing a ripple effect. And it's spilling over into what's the relationship with China going to look like? That's the big outstanding question mark. Are they going to take a step more in the direction of supporting Russia, which right now they're not really clear on what they're doing, or are they going to take a step more in the hey, I want to be an Eastern type alliance here because I realize that economic benefit to the country of China is so much more than that of backing Russia.
Yeah, I think again, my wife's Taiwanese. I've been to Taiwan. I've been to China, right? So I have some experience there, not claiming to be an expert by any means on that policy, but I can tell you that a lot of their demand doesn't come from Russia, right? At the end of the day, China will do what's good for China.
Right. And I tend to agree with you there that they cannot afford to make that economic mistake of backing a quote unquote friend that really there is not all that much outside of military, I guess. Yeah. I mean, I don't even know what the the huge overarching benefit.
The only benefit to them is the enemy of your enemy is my friend. That's all it is.
Right.
I mean, it's not economic. It's not China. There is no upside. At the end of the day, China, their leadership, Xi Jinping, will always make the call on what is. And again, what the beauty about China, whether you like it or not, is they are thinking in decades. They're not thinking in years.
Right.
Russia has been and never will be a large importer of Chinese goods. The economy is not that big.
Right. And let's hope that when Germany and Europe, as they wean off this oil dependency, let's hope that pipeline doesn't just get shifted in another direction and starts to get bought up by China. Like that would be, because that empowers obviously Putin and his bad decision making in general.
Yeah. And then so let's get back to Goldman, right? So because this is really in my opinion, this is what it's boiled down to. In my opinion, could be totally wrong. I believe the people that are backing BlackRock are really jumping into the buy the dip phenomenon. Because again, I do believe if you can time the market when the Fed goes dovish again, you're going to make a lot of money. If you can time the meeting that they're going to go dovish, you will make a lot of money. Because up until then, I see pain.
Mm-hmm.
If you are in BlackRock's camp, the window of opportunity won't be that long, right? It'll be months. If you're in Goldman's camp, in my camp, you've got quarters.
Yep.
That's kind of how
I was going to bring up that exact point. It's all about your time frame that you're looking at, because BlackRock is essentially saying the economy's not that strong, and therefore rates won't be able to be moved as quickly. And therefore, when they make that dovish pivot, you're saying there's going to be a bounce off the bottom. No doubt, I agree with that. The other side of it is Goldman saying the economy is stronger and they can take more tightening before it breaks. And therefore, the period of time is a little bit longer until the breaking happens, but it might be a little more violent when it happens on that end.
I think that's exactly right. That's what I'm calling for and again, I want to be very clear. I don't actually think the economy is all that healthy. Like when I think if you were to step back and blend the average of the mom and pop home, it's very much the 1970s. People right now, CBS did a poll. I talked about it on my daily financial news. Greater than 60% of families are making tough choices already. Entertainment down, driving down, food. They're going to off-brand food already. They're still buying. They're just buying lower quality or different stuff. So I really don't think the economy is that strong. I just think we have so much inertia that momentum is going to it takes a while to slow it down.
And we talked about this before, that we both don't believe that the bottom up, the lower end of the market is all that flush right now. And that's the market that drives the economy. We bring this up a lot. And the fact that, Michael, you're not going to make a decision that's all that dramatically different based upon what happens in the short term here with inflation or whatever it is. But the people on the bottom end really do. They live paycheck to paycheck. So if the economy is better, they're going to be getting paid and flushing that into the system. If the economy is weaker, like I tend to believe it is, they might not be spending that money in the market, and therefore they may be looking at it to spend on things and holding it back and not.
It's all necessity.
Catalyzing.
Yeah, it's necessity. It's going to be very interesting, folks. I don't think anybody is arguing from BlackRock to Goldman that the Fed's going to be tightening pretty aggressively, likely 250 basis point moves. I think that's even the bet right now. If you look at Wall Street, the next two moves are 50 basis points. I think where the disagreement happens is after that. And again, if you can time when the Fed's going to go dovish, you can make a lot of money. I don't watch it enough to make that bet, but this is going to be a lot of stuff. Taylor, where can people find you?
Find us at Life Goal Investments on all the social platforms. So Instagram, Twitter, etc. And then our website's www.lifegoalinvestments.com.
Awesome, buddy. Thank you very much.
Thanks so much, Michael.